In financial markets, a share, sometimes someone can refer to as stock or equity, is a unit of equity ownership in the capital stock of a corporation. It can refer to units of mutual funds, limited partnerships, and real estate investment trusts. Share capital refers to all of the shares of an enterprise. The owner of shares in a company is a shareholder, or stockholder, of the corporation. A share expresses the ownership relationship between the company and the shareholder. The denominated value of a share is its face value, and the total of the face value of issued shares represent the capital of a company, which may not reflect the market value of those shares. The income received from the ownership of shares is a dividend. There are different types of shares such as equity shares, preference shares, deferred shares, redeemable shares, bonus shares, right shares, and employee stock option plan shares. Shares are valued according to the various principles in different markets, but a basic premise is that a share is worth the price at which a transaction would be likely to occur were the shares to be sold. The liquidity of markets is a major consideration as to whether a share is able to be sold at any given time. An actual sale transaction of shares between buyer and seller is usually considered to provide the best prima facie market indicator as to the true value of shares at that particular time. A minority discount is usually applied when valuing a minority shareholding, less than 50%, where ownership of the shares offers limited control over the business if this is held by a majority shareholder. Tax treatment of dividends varies between tax jurisdictions. For instance, in India, dividends are tax-free in the hands of the shareholder up to INR 1 million, but the company paying the dividend has to pay dividend distribution tax at 12.5%. There is also the concept of a deemed dividend, which is not tax-free. Further, Indian tax laws include provisions to stop dividend stripping. Historically, investors were given share certificates as evidence of their ownership of shares. In modern times, certificates are not always given and ownership may be recorded electronically by a system such as CREST or DTCC, a central securities depository. In finance, equity is an ownership interest in property that may be subject to debts or other liabilities. Equity is measured for accounting purposes by subtracting liabilities from the value of the assets owned. For example, if someone owns a car worth $24,000 and owes $10,000 on the loan used to buy the car, the difference of $14,000 is equity. Equity can apply to a single asset, such as a car or house, or to an entire business. A business that needs to start up or expand its operations can sell its equity in order to raise cash that does not have to be repaid on a set schedule. When liabilities attached to an asset exceed its value, the difference is called a deficit and the asset is informally said to be underwater or upside down. In government finance or other non-profit settings, equity is known as net position or net assets. Origins. The term equity describes this type of ownership in English because it was regulated through the system of equity law that developed in England during the late Middle Ages to meet the growing demands of commercial activity. While the older common law courts dealt with questions of property title, equity courts dealt with contractual interests in property. The same asset could have an owner in equity, who held the contractual interest, and a separate owner at law, who held the title indefinitely or until the contract was fulfilled. Contract disputes were examined with consideration of whether the terms and administration of the contract were fair, that is, equitable. Single assets. Any asset that is purchased through a secured loan is said to have equity. While the loan remains unpaid, the buyer does not fully own the asset. The lender has the right to repossess it if the buyer defaults, but only to recover the unpaid loan balance. The equity balance, the asset's market value reduced by the loan balance, measures the buyer's partial ownership. This may be different from the total amount that the buyer has paid on the loan, which includes interest expense and does not consider any change in the asset's value. When an asset has a deficit instead of equity, the terms of the loan determine whether the lender can recover it from the borrower. Houses are normally financed with non-recourse loans, in which the lender assumes a risk that the owner will default with a deficit, while other assets are financed with full recourse loans that make the borrower responsible for any deficit. The equity of an asset can be used to secure additional liabilities. Common examples include home equity loans and home equity lines of credit. These increase the total liabilities attached to the asset and decrease the owner's equity. Business entities. A business entity has a more complicated debt structure than a single asset. While some liabilities may be secured by specific assets of the business, others may be guaranteed by the assets of the entire business. If the business becomes bankrupt, it can be required to raise money by selling assets. Yet the equity of the business, like the equity of an asset, approximately measures the amount of the assets that belongs to the owners of the business. In financial accounting, the equity is derived by subtracting its liabilities from its assets. For a business as a whole, this value is sometimes referred to as total equity, to distinguish it from the equity of a single asset. The fundamental accounting equation requires that the total of liabilities and equity is equal to the total of all assets at the close of each accounting period. To satisfy this requirement, all events that affect total assets and total liabilities unequally must eventually be reported as changes in equity. Businesses summarize their equity in a financial statement known as the balance sheet, or statement of net position, which shows the total assets, the specific equity balances, and the total liabilities and equity, or deficit. Various types of equity can appear on a balance sheet, depending on the form and purpose of the business entity. Preferred stock, share capital, or capital stock, and capital surplus, or additional paid-in capital, reflect original contributions to the business from its investors or organizers. Treasury stock appears as a contra-equity balance, an offset to equity, that reflects the amount that the business has paid to repurchase stock from shareholders. Retained earnings, or accumulated deficit, is the running total of the business's net income and losses, excluding any dividends. In the United Kingdom and other countries that use its accounting methods, equity includes various reserve accounts that are used for particular reconciliations of the balance sheet. Another financial statement, the statement of changes in equity, details the changes in these equity accounts from one accounting period to the next. Several events can produce changes in a firm's equity. Capital investments, contributions of cash from outside the firm increase its base capital and capital surplus by the amount contributed. Accumulated results, income or losses may be accumulated in an equity account called retained earnings or accumulated deficit, depending on its net balance. Unrealized investment results, changes in the value of securities that the firm owns, or foreign currency holdings, are accumulated in its equity. Dividends, the firm reduces its retained earnings by the amount of cash payable to shareholders. Stock repurchases, when the firm purchases shares into its own treasury, the amount paid for the stock is reflected in the treasury stock account. Liquidation, a firm that liquidates with positive equity can distribute it to owners in one or several cash payments. Investing. Equity investing is the business of purchasing stock in companies, either directly or from another investor, on the expectation that the stock will earn dividends or can be resold with a capital gain. Equity holders typically receive voting rights, meaning that they can vote on candidates for the board of directors and, if their holding is large enough, influence management decisions. Legal foundations. Investors in a newly established firm must contribute an initial amount of capital to it so that it can begin to transact business. This contributed amount represents the investor's equity interest in the firm. In return, they receive shares of the company's stock. Under the model of a joint stock company, the firm may keep contributed capital as long as it remains in business. If it liquidates, whether through a decision of the owners or through a bankruptcy process, the owners have a residual claim on the firm's eventual equity. If the equity is negative, a deficit, then the unpaid creditors bear loss and the owner's claim is void. Under limited liability, where the financial liability is limited to a fixed sum, owners are not required to pay the firm's debts themselves so long as the firm's books are in order and it has not involved the owners in fraud. When the owners of a firm are shareholders, their interest is called shareholders' equity. It is the difference between a company's assets and liabilities, and can be negative. If all shareholders are in one class, they share equally in ownership equity from all perspectives. It is not uncommon for companies to issue more than one class of stock, with each class having its own liquidation priority or voting rights. This complicates analysis for both stock valuation and accounting. A company's shareholder equity balance does not determine the price at which investors can sell its stock. Other relevant factors include the prospects and risks of its business, its access to necessary credit, and the difficulty of locating a buyer. According to the theory of intrinsic value, it is profitable to buy stock in a company when it is priced below the present value of the portion of its equity and future earnings that are payable to stockholders. Advocates of this method have included Benjamin Graham, Philip Fisher, and Warren Buffett. An equity investment will never have a negative market value, i.e., become a liability, even if the firm has a shareholder deficit, because the deficit is not the owner's responsibility. An alternate approach, exemplified by the Merton model, values stock equity as a call option on the value of the whole company, including the liabilities, struck at the nominal value of the liabilities. The analogy with options arises in that limited liability protects equity investors, where the value of the firm is less than the value of the outstanding debt, shareholders may, and therefore would, choose not to repay the firm's debt. 2. Where firm value is greater than debt value, the shareholders would choose to repay, i.e., exercise their option and not to liquidate. Shares outstanding are all the shares of a corporation that have been authorized, issued, and purchased by investors and are held by them. They are distinguished from treasury shares, which are shares held by the corporation itself, thus representing no exercisable rights. Shares outstanding and treasury shares together amount to the number of issued shares. Shares outstanding can be calculated as either basic or fully diluted. The basic count is the current number of shares. Dividend distributions and voting in the general meeting of shareholders are calculated according to this number. The fully diluted shares outstanding count, on the other hand, includes diluting securities, such as warrants, capital notes, or convertibles. If the company has any diluting securities, this indicates the potential future increased number of shares outstanding. Finding the number of shares outstanding. The number of outstanding shares may change due to changes in the number of issued shares, as well as the change in treasury shares. Both can occur at any time of the year. There are several useful public sources to find the number of shares outstanding of a given corporation. Public traded companies investor relations. The financial reporting obligation of the publicly traded company also ensures the publication of issued and outstanding shares. The reports are usually available in the investor relations section of the company's website. Web directories are supporting direct access to company websites. Publicly traded companies bundle the reports in the investor relations section, e.g. Deutsche Bank, ENIS.P.A of InBev, EDP, Energias do Brasil Our Accor SA. Authorized Information Service. In many countries, there is an information service authorized or provided by the local financial authority which gives access to companies' financial reporting. In the United States, the number of shares outstanding may be obtained from quarterly filings with the U.S. Securities and Exchange Commission. Quarterly filings are accessible using the U.S. EDGAR. In Germany, those figures are available using the German Company Register, the central platform for storage of company data. In the Netherlands, the Netherlands Authority for the Financial Markets, AFM, provides on its website a register of issued capital. In Italy, the Commissione Nazionale per le Società e la Borsa, CONSOB, provides on its website a register of issuers with latest total shares. Local stock exchanges. Since outstanding shares are an essential detail of publicly traded companies, the number can be found on the local stock exchange websites. Beyond stock charts and listed prices, they also provide the company's number of outstanding shares. Examples include the Brazilian BM and FBOVESPA, the Swiss SIX, the Borsa Italiana and the Tel Aviv Stock Exchange, where shares outstanding are termed capital listed for trading. A treasury stock or reacquired stock is stock which is bought back by the issuing company, reducing the amount of outstanding stock on the open market including insiders' holdings. Stock repurchases are used as a tax-efficient method to put cash into shareholders' hands, rather than paying dividends, in jurisdictions that treat capital gains more favorably. Sometimes, companies repurchase their stock when they feel that it is undervalued on the open market. Other times, companies repurchase their stock to reduce dilution from incentive compensation plans for employees. Another reason for stock repurchase is to protect the company against a takeover threat. The United Kingdom equivalent of treasury stock as used in the United States is treasury share. Treasury stocks in the UK refers to government bonds or gilts. Limitations of treasury stock. Treasury stock is not entitled to receive a dividend. Treasury stock has no voting rights. Total treasury stock cannot exceed the maximum proportion of total capitalization specified by law in the relevant country. When shares are repurchased, they may either be cancelled or held for reissue. If not cancelled, such shares are referred to as treasury shares. Technically, a repurchased share is a company's own share that has been bought back after having been issued and fully paid. The possession of treasury shares does not give the company the right to vote, to exercise preemptive rights as a shareholder, to receive cash dividends, or to receive assets on company liquidation. Treasury shares are essentially the same as unissued capital, which is not classified as an asset on the balance sheet, as an asset should have probable future economic benefits. Treasury shares simply reduce ordinary share capital. Buying back shares. Benefits. In an efficient market, a company buying back its stock should have no effect on its price per share valuation. If the market fairly prices a company's shares at $50/share, and the company buys back 100 shares for $5,000, it now has $5,000 less cash but there are 100 fewer shares outstanding. The net effect should be that the underlying value of each share is unchanged. Additionally, buying back shares will improve price/earnings ratios due to the reduced number of shares, and unchanged earnings, and improve earnings per share ratios due to fewer shares outstanding, and unchanged earnings. If the market is not efficient, the company's shares may be underpriced. In that case, a company can benefit its other shareholders by buying back shares. If a company's shares are overpriced, then a company is actually hurting its remaining shareholders by buying back stock. Incentives. One other reason for a company to buy back its own stock is to reward holders of stock options. Call option holders are hurt by dividend payments, since, typically, they are not eligible to receive them. A share buyback program may increase the value of remaining shares, if the buyback is executed when shares are underpriced. If so, call option holders benefit. A dividend payment short-term always decreases the value of shares after the payment, so, for stocks with regularly scheduled dividends, on the day shares go ex-dividend, call option holders always lose whereas put option holders benefit. This does not apply to unscheduled, special, dividends since the strike prices of options are typically adjusted to reflect the amount of the special dividend. Finally, if the sellers into a corporate buyback are actually the call option holders themselves, they may directly benefit from temporary unrealistically favorable pricing. After buyback, the company can either retire, cancel, the shares. However, retired shares are not listed as treasury stock on the company's financial statements, or hold the shares for later resale. Buying back stock reduces the number of outstanding shares. Accompanying the decrease in the number of shares outstanding is a reduction in company assets, in particular, cash assets, which are used to buy back shares. Accounting for treasury stock. On the balance sheet, treasury stock is listed under shareholders' equity as a negative number. It is commonly called treasury stock or equity reduction. That is, treasury stock is a contra account to shareholders' equity. One way of accounting for treasury stock is with the cost method. In this method, the paid-in capital account is reduced in the balance sheet when the treasury stock is bought. When the treasury stock is sold back on the open market, the paid-in capital is either debited or credited if it is sold for less or more than the initial cost respectively. Another common way for accounting for treasury stock is the PAR value method. In the PAR value method, when the stock is purchased back from the market, the books will reflect the action as a retirement of the shares. Therefore, common stock is debited and treasury stock is credited. However, when the treasury stock is resold back to the market, the entry in the books will be the same as the cost method. In either method, any transaction involving treasury stock cannot increase the amount of retained earnings. If the treasury stock is sold for more than cost, then the paid-in capital treasury stock is the account that is increased, not retained earnings. In auditing financial statements, it is a common practice to check for this error to detect possible attempts to cook the books. In the United States, buybacks are covered by multiple laws under the auspices of the Securities and Exchange Commission. In the UK, the Companies Act 1955 disallowed companies from holding their own shares. However, the Companies Act 1985 later repealed this. In economics and law, issued shares are the shares of a corporation which have been allocated, allotted, and are subsequently held by shareholders. The act of creating new issued shares is called issuance. Allotment is simply the transfer of shares to a subscriber. After allotment, a subscriber becomes a shareholder, though usually that also requires formal entry in a share registry. The number of shares that can be issued is limited to the total authorized shares. Issued shares are those shares which the board of directors and/or shareholders have agreed to issue, and which have been issued. Issued shares are the sum of outstanding shares held by shareholders, and treasury shares are shares which had been issued but have been repurchased by the corporation. The latter generally have no voting rights or rights to dividends. The issued shares of a corporation form the equity capital of the corporation, and some corporations are required by law to have a minimum value of equity capital, while others may not need any or just a nominal number. The value of the issued shares is determined at the time they are issued, and the value does not change in relation to the issuing corporation after that time. Shares are most commonly issued fully paid, in which case the liability of the shareholders is limited to the amount paid on the shares, but they may also be issued shares that are partly paid, with unlimited liability, subject to guarantee, or some other form. The authorized capital of a company, sometimes referred to as the authorized share capital, registered capital or nominal capital, particularly in the United States, is the maximum amount of share capital that the company is authorized by its constitutional documents to issue, allocate, to shareholders. Part of the authorized capital can, and frequently does, remain unissued. The authorized capital can be changed with shareholders' approval. The part of the authorized capital which has been issued to shareholders is referred to as the issued share capital of the company. The device of the authorized capital is used to limit or control the ability of the directors to issue or allot new shares, which may have consequences in the control of a company or otherwise alter the balance of control between shareholders. Such an issue of shares to new shareholders may also shift the profit distribution balance. For example, if new shares are issued at face value and not at market value. The requirement for a company to have a set authorized capital was abolished in Australia in 2001, and in the United Kingdom, it was abolished under the Companies Act 2006. Thank you for watching this video.